Even in a market where stock prices feel sky high, there are still hidden gems, companies trading below their true value. These aren't speculative penny stocks, these are established businesses with real earnings, steady growth, and the potential to deliver significant returns over the next few years. Let's take a look at 8 undervalued stocks that savvy investors should consider. Northern Oil and Gas, ticker NOG, is based in Minnesota and takes an unconventional approach to energy. Instead of running drilling rigs or building massive infrastructure, they acquire minority interests in oil and gas wells, primarily in the Williston, Permian, and Appalachian basins. This keeps costs low while still allowing exposure to production growth. In 2024, they reported strong earnings despite volatile oil prices, thanks to disciplined cost management and smart acquisitions. Consistent dividends make NOG attractive for income-focused investors. Their partnerships with major shale operators give them access to prime drilling opportunities. The main risk? Their profits are closely tied to energy market swings. MGP Ingredients, ticker MGPI, headquartered in Kansas, produces specialty ingredients and premium spirits, including bourbon and rye whiskey, as well as wheat proteins and starches for food production. With the U.S. premium spirits market thriving, MGP has moved from being a behind-the-scenes supplier to building recognizable brands with higher margins. Their diversified revenue streams across food and spirits, combined with strong brand recognition, position them for growth. Cyclical alcohol demand and fluctuating wheat costs remain risks. Overseas Shipholding Group, ticker OSG, is a US-based marine transportation company focused on energy shipping, especially crude oil and refined products within the Jones Act market. Tankers and barges operated by OSG are crucial to the domestic energy supply chain. Regulatory protection limits foreign competition, giving them a strong market position. Steady demand and a solid balance sheet support ongoing fleet upgrades. Risks include capital-intensive vessel maintenance and reliance on energy sector cycles. RBC Bearings, ticker RBC, designs and manufactures precision bearings for aerospace, defense, and industrial applications. These are mission-critical components, built to perform under extreme conditions. Long-term contracts with major aerospace manufacturers provide predictable revenue, while high entry barriers and strong engineering capabilities reinforce their competitive edge. However, reliance on a small number of large customers and sensitivity to economic slowdowns are potential drawbacks. Geopark Limited, ticker GPRK, headquartered in Chile, operates across Colombia, Ecuador, Brazil, and Chile. Known for operational efficiency and strong reserve growth, Geopark generates consistent free cash flow, enabling dividend payments and investment in growth projects. Diversification across multiple countries and disciplined capital management are strengths. Geopolitical risk, currency fluctuations, and global oil price sensitivity are the main concerns. SkyWest, ticker Sky, is the largest regional airline in the US, operating flights for Delta, United, American, and Alaska Airlines. Their business model under capacity purchase agreements ensures revenue is earned even when flights aren't full. Investments in fuel-efficient aircraft enhance operational efficiency. Strengths include revenue stability and strong airline partnerships. Risks involve labor costs, pilot shortages, and fuel price volatility. Grupo Aeroportuario del Centro Norte, ticker OMAR, operates 13 airports in central and northern Mexico, including key tourist and business hubs. Long-term government concessions provide predictable revenue, while retail and parking operations supplement income. Regional dominance and growing passenger traffic are advantages. Economic slowdowns or unforeseen events like pandemics pose risks. Petro, ticker PBR, is a Brazilian oil and gas giant with massive offshore reserves. Focused on ultra-deepwater projects, Petro has delivered strong profits thanks to high oil prices and operational efficiency. The company offers high dividend payouts, strong cash flow, and world-class reserves. Risks include political interference and reliance on global oil prices. When we look at the numbers, several companies stand out. Geopark offers an 11.4% dividend yield, 46.78% gross margin, and EPS of 0.83 at a PE of just 3.9. Northern Oil and Gas shows similar value with a 6.8% yield, 37.49% gross margin, and EPS of 66 at a PE of 4.0. Overseas Shipholding Group also features a low PE with solid margins. Grupo Aeroportuario del Centro Norte has a 61% gross margin and EPS of 545 at a PE of 16.1, while SkyWest provides strong per-share earnings at a modest valuation. RBC maintains steady margins at a higher multiple, and MGP Ingredients, despite strong margins, has a short-term negative EPS. From a value perspective, Geopark, Northern Oil and Gas, Petro, and Overseas Shipholding Group offer low PEs, high EPS, and strong margins, representing the most compelling bargains. Grupo Aeroportuario del Centro Norte and SkyWest balance valuation and earnings, RBC offers stability, and MGP Ingredients may rebound as earnings recover. For long-term investors, these companies provide a mix of income, growth, and strategic positioning across energy, industrials, transportation, and infrastructure. The key is understanding the sector-specific risks and holding with a long-term perspective. Investing in these undervalued stocks today could position you for strong returns in the years ahead.